Hi guys, this is episode 1 of Australian Economy Roundup. This is just going to focus on a lot of charts and ratios that pertain to the health of the Australian economy. The first sort of group will go through the capital rotation event that's happening into the gold complex, gold and metals, away from Australian dollars or fiat currency. So the first chart we have here is gold priced in Australian dollars. So if the chart's going up, gold's stronger. The chart's going down, the Aussie dollar is stronger. So you can see we've been in a overall uptrend since 2017. How far back we have this chart priced in Australian dollars. Obviously, it goes back a lot further in USD charts. So we had a blow off top earlier this year, and it's in a corrective phase at the moment. But you can see we have a long-term support line here. That it may not go down. I think if it breaks below this moving 36 3-year moving average, it might go all the way down to the support line, or it could just bounce off that 3-year moving average line. But the long-term forecast is for gold to go higher. So now we'll move on to the XJO. So Australian stocks are already in a bear market versus gold, but still the bull trend remains intact while price is holding above the cloud and key moving averages. It has gone under the 3 moving average. And so if that trend sort of continues, that's just going to help confirm the capital rotation event into the gold complex, like gold, silver, copper, etc. So you'll see here we did break above this long-term resistance, this yellow line, but then we broke back below it. Then I think we might actually then drop down to this support zone. So that's the XJO, the XSO. Is the smaller stocks, small caps. Just bring this in. So small caps tend to be highly sensitive to liquidity and economic growth. So you see here where it's gone down. We had the GFC, sharp downturn with COVID, and then it's been an uptrend for the last 6 years, and now it's sort of bouncing off this rising wedge pattern here. So whilst it's above the cloud at both of the moving averages, it's in a bull market, but it has lost that 3 moving average. So it's a bit of a concern at the moment on the small caps. So we'll move on to the XJO versus the Nasdaq. So the Nasdaq is all the big tech over in the US. So if this ratio is going down, it's favoring the Nasdaq. So that's been in a 4-year downtrend where it's better to be in the Nasdaq than in the ASX. and that doesn't look like stopping anytime soon. It's even broken down even below that 40-year downtrend. It's gone down even further. So that just shows you how the Nasdaq is going and how the Australian ASX is going. So now we've got gold versus the ASX 200. So when the ratio is going up, gold is outperforming Aussie stocks. And when the ratio is going down, stocks are outperforming gold. So you can see here, the ratio is going up. So gold is outperforming the ASX. So it's better to be in gold right now. And you can see the rotation was better around into COVID to be in gold. That was better to be in the ASX 200. Now it's better to be in gold again, even though it has done a little pullback at the moment. Gold versus small caps, ASX small caps. So again here, you can see these capital rotation moments going on, where it's better to be in either gold or it's better to be in the small caps. So at the moment, had another breakout back here in November 2023, where it's better to be in gold, and that's been in an uptrend ever since. So now we've got gold price in AUD versus equal weighted ASX. So if the ratio is rising, gold is outperforming Australian equities. So you can see again how much it's accelerating since the breakout, really back in the start of 2022, and it's really accelerated since then. It did touch this support and has bounced off, so gold is currently correcting rather than, I think, the ASX outperforming. So gold priced in gold versus the Nasdaq, and again you can see if the chart's going up, it's better to be in gold. If the chart's going down, it's better to be in Nasdaq. And at the moment, the Nasdaq is outperforming gold. So now we move on to silver priced in AUD, and a bit of a roadmap of the long-term view. So silver historically moves faster than gold, especially during speculative precious metal phases. So you can see here we broke out in this time last year, had a big blow off top at the start of the year. It's going through a bit of a corrective phase. So scenario is that it either bounces off the 3-year moving average or bounces off this long-term support and then goes higher in the years to come. So now we have silver priced in Aussie dollars versus the ASX. So again, if the ratio is going up, it's better to be in silver. And you can see here we've broken out September last year, and it's been better to be in silver than the ASX. Silver versus the small caps. So again, charts going up, better to be in silver. Charts going up, uptrend here. The Australian gold miners, GDX. So miners typically outperform later in precious metal bull markets. So you can see the chart's going up, sort of broke out back in 24, and it's been going up ever since. Again, at the moment, the miners and the metals are correcting, but still in a bull market. So GDX, the miners versus the actual physical gold. If this ratio is going up, it's better to be in the miners. So this is a bit of choppiness sideways where it's not really one or the other. If GDX gets above this horizontal dash line I have here, I think it's going to be really good to be in the miners. So we can look for that. And this is just the Nasdaq. And you can see it's just been an uptrend, and it's currently above the cloud, above the moving averages. So it's just melting up at the moment. All right, next group we'll go through is more things related to credit, property, and the local economy. So here we have a basket of construction infrastructure stocks or equities versus the ASX. Just create some space here. Okay, so we've got these four stocks, the JHX, REH, MGH, and SGH, which track housing cycle, plumbing, building demand, infrastructure, resources, heavy equipment, mining, construction exposure, versus the Australian stock market. So if this is going up, it's better to be in construction and infrastructure. If it's going down, it's better to be in the ASX. As you can see, this is going down. You can see really deteriorating here. There's a long-term support line here, and it's around about there. So it's not looking good for construction and infrastructure at the moment. The next chart we have here is Australian consumer stress index. So the high ratio, tighter monetary conditions. So this is just showing us the interest rates that's happening with consumer confidence. Next one we've got is CCP, which is the Credit Corp Group. So this company makes money by collecting debt. So if the price is falling on this stock, it means people are struggling to pay back the money. So these people buy other companies' debt, and then they try and chase it up. And then when they're not getting paid, is then obviously the people who are owing money can't pay it. So as you can see, there's a key level here where it's just sitting on. if it gets below this, it's a sign that people are struggling to pay back their debt. Next chart is the ASX real estate index. So you see here, it's on a downswing. Did even go below this this support, rising support line. So the property stocks are continuing to struggle to break out above this support, this resistance level. So again, it's below the 3-year moving average. It's starting to test the 1-year moving average, and if it gets below the cloud, it's definitely in a bear market. Next one we have is the Australian real estate index versus gold. So if the chart is going down, it's better to be in gold. You can see here that Australian real estate is in a bear market versus gold. Next one we have is the ASX financial index. So this is all equities tied to mortgage lending and property prices. That's actually going still pretty good. Usually late in an economic cycle, banks are doing still quite well. You can see here it broke out back in start of 24, and it's just been a very strong uptrend, but may have found a ceiling. Has gotten below the 3-year moving average, so it may test the 1-year moving average, but still in an uptrend. Australian financial index versus gold. So you can see here versus gold, the banks and financials are actually in a bear market. Australian properties versus the financial index. So this showing the financials are actually holding up better than property. So there's a bit of divergence going on here where everything's supporting Australian property has not been better than the actual other services that get you into property. The Aussie 10-year yield. So let's just get this chart in. So if we're above 5%, there's a lot of pressure in the economy. If we get below 3%, there's more liquidity, and there's any rapid moves, a lot of instability. Australia has one of the highest household debt to income ratios globally. So here we see we're in a rising wedge pattern here. We're testing that mortgage and credit stress bands here. So when this goes up, it's getting a bit more pressure going on. So the Aussie 10-year minus the 3 year. That's 3-year spread. So this is the difference between long-term growth expectations and short-term central bank policy. So at the moment, sort of in a normal growth environment, but we are testing where it does invert, where you can get a bit of a credit warning. And you can see here where it was inverted. We had the GFC, COVID shock here, and here it's below the moving averages and almost below the cloud as well. So here we have silver price in Australian dollars versus Australian inflation. So obviously silver is massively been outperforming inflation since it broke out in April 2024. So this one we've got Aussie homes priced in gold. So back in 2012, it was more expensive to buy a home in gold, whereas now it's actually cheaper to buy a house in gold. So it just shows you that how much gold preserves purchasing power. But in fiat terms, houses obviously went up, but in real money, gold, houses went down. It's the Australian unemployment rate. So that's obviously upticking. I think here we're at 4.5. So it's upticking unemployment. The Australian consumer confidence, testing the lows. So Australian consumer confidence is down right now. The Australian stock market versus consumer confidence. So as this is rising, so this, even though consumer confidence is at its all-time low, the Australian stock market is still going good. And then on top of that, gold is going even better. Australian consumer discretionary. So you can see here there's this divergence happening. So that blue line is the Australian stock market, the ASX, which it was pretty much they're tracking each other until about this time last year. The ASX continued to go up, but consumer discretionary spending is all the way down here. So people are tightening up their belts due to all of this inflation that's happening in everyday goods. So this is the Australian K-shaped economy, where we have the Australian ASX still trending up, yet spending in higher income and also other broad household discretionary items are at its all-time low. So you can see here, that blue line is the ASX 200, and the chart is higher income consumer spending. So it's a basket of LOV, CTT, and PMV, which is premium retail brands, luxury brands, fashion, jewelry spending is like basically testing the lowest ever. And then this one's more household discretionary, like JBH, Harvey Norman, footwear, baby products. Again, it's this divergence that's happening here. All right, then we'll move on to commodities. So here we have copper priced in AUD versus the Australian dollar. So you can see here, as the chart's going up, it's better to be in copper than it is in Aussie dollars. And again, that broke out start of the year, or end of December last year. Now it's trending up. So you can see that hard assets are leading into this current late part of the cycle. Now we have oil priced in Aussie dollars. So with the charts going up, oil is costing us more. So oil is trying to break out to be higher. It's been this long-term downtrend, and then it broke out in about February, March this year. Now we have how the Aussie banks are going. So Australian banks remain highly leveraged to residential property. So it broke out back in January 2024, and it's been this long-term trend support and rising resistance channel, but again it has lost that 3-year moving average. So we'll see how the Aussie banks hold up. Here we have Commonwealth Bank versus gold, and every time this chart is going down, it's better to be in gold than in the banks, and this tends to happen around financial crises. So we had a breakdown here in the GFC financial crisis. Then almost 18 years later, again, it's broken down. So have we got a potential crisis window coming up in the next year? The Australian currency versus US dollar. So again, we broke out early this year. As the Aussie dollar gets stronger, it's more risky. And then if the Aussie dollar weakens, there's risk off and better for growth. So that's something we'll have to keep watching. The Aussie dollar versus gold. So obviously, chart's going down, it's better to be in gold. So you can see the purchasing power that we have is just getting whittled away with Aussie dollars. In the last chart, in the crypto space, so this is Bitcoin priced in AUD. So it broke out back in 24, had its blow off top start this year, and it's been in a bit of a corrective phase. But in Aussie dollars, Bitcoin's still in a bull market. It's above the clouds, above the moving averages. It's just whether if things start to break down due to the cost of living, then Bitcoin might be something people start selling just to get some more cash back. I might look at this on the weekly. So on the weekly, it's still in a bull environment, but if it gets below the 3-year moving average, that support line, the 1-year moving average, and the cloud, we're definitely going to be in a bear market. Then Bitcoin versus gold. This is on the weekly. You can see here that it's way better to be in gold than it is in Bitcoin. So I look to update this once a month and see how the Australian economy is going. If there's any other charts you'd like me to look at, please put it in the comments. Or if you have any other questions. Thanks for watching.